Hello everyone and welcome to the BetaShares Economic Outlook. Can we avoid a hard landing with David Bassanese, our Chief Economist here at BetaShares, and myself, Chris Yates, a Director here at BetaShares. Now, just before we get into today's Echo update, the important slide, I'll give everyone a moment to have a quick read of this, and obviously just highlighting that key one there in terms of past performance is not indicative of future performance, and of course, anything discussed today is very much general in nature and doesn't take into account anyone's personal circumstances. So the webinar today will be recorded as always, so if you happen to miss anything or want to go back over any of the key points that David has covered today, you'll be able to do that. You'll receive the slides and the webinar sent out to you shortly after the conclusion of today. And thank you all those people who have already sent through those questions for David, and we will be spending some time at the end to go through as many of those as possible. But as David covers the different topics today, please feel free to write through any other questions that may be coming across. To keep you informed on all our funds, portfolio and economic insights, what I would say is to go on our website. It's a great source of information. You can find information on our funds, blogs and investment information as well. And also we have our Bassanese Bites, which David writes, that comes out on every Monday. So you can go on our website there and sign up for that newsletter, as well as some portfolio insights and other information. And to keep across all this, you can follow us on our Twitter page, LinkedIn, Facebook, and some really informative videos on YouTube as well. So a little bit about BetaShares and an update from our side, and of course, welcome to anyone that's new to BetaShares today, and also welcome back to those who have taken the time to review and select BetaShares funds in the past for their portfolios and investments. BetaShares, we have 71 different ASX listed investment strategies that you can access, from low cost Aussie equity exposures at 7 basis points to global thematics, goals-based ETF strategies and fixed income as well. And with that, we have had strong support from our Australian investors with $22 billion under management. So thank you again for supporting us here at BetaShares. And being an Aussie founded ETF fund manager, our key objective, as always, is to provide intelligent investment solutions which help Australian investors meet their financial objectives. So we're very lucky to have David Bassanese, our BetaShares Chief Economist, here today. He's going to be sharing some insights with us. And his credentials are that he used to be economist at the AFR. He was a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, Treasury and OECD economist. And with all that, he also wrote a book. So if you're looking to learn more about portfolio construction within ETFs, I implore you to go on and look at the Australian ETF guide. So the agenda today, very topical, RBA Outlook. What is forcing the RBA's hand to increase interest rates earlier than what was initially expected? And of course, if the US sneezes, Australia tends to catch a cold. So what is happening over there in the US in terms of the Fed outlook as well? David will then be going through financial markets, looking at both domestic and international equities, covering what's happening in the fixed income side of the market, which of course is off the back of these interest rate increases and outlooks, commodities, and also touching on the Aussie dollar as well, I believe. Post that, he'll be going into some investment themes, so looking at what is happening in markets and potentially where you can place your portfolios to benefit either from growth or some of these more cyclical inflationary exposures as well. So with no further ado, I will pass it over to David now to cover the RBA Outlook to start. I'll be back at the end of the webinar today to go through some Q&As with David.
Thanks very much, Chris, and great to be with you today for the quarterly update. A lot going on in markets, of course. Probably a trickier period in markets now than we've been enjoying in the couple of years since COVID. So I'll try as best I can to sort of give you an update on the situation and in terms of the outlook, and if only just sort of explain what's going on at the moment, and a bit of a sense of how things might pan out from here, or at least know what the risks are. So firstly, in terms of the RBA outlook, as Chris mentioned, this is a chart of the RBA cash rate and the differential of the cash rate to the US cash rate. So the dotted line there is what the market expects the cash rate to do over the next couple of months. And as you can see, very aggressive rate rises are priced in. So as we know, the RBA's already raised rates by 25 points, taking the cash rate up from 0.1%, virtually near zero, to 0.35%. My expectation is they'll raise rates probably another 40 basis points at the next meeting in June. Now, why 40 points? Because that'll take the cash rate to 0.75% and get it back to what historically has been these quarter percentage point levels. RBA's usually move rates around in a 25-point increment, and so the cash rates are 1.25 or 1.5 or 2.5. So it's usually around those quarter point increments. So that's why the many in the markets think they might go by 0.4 to just get it back to say 0.75, and thereafter moving quarter point increments from there. Now, as it stands, the market is expecting something like a cash rate of 3.5%, would you believe, by the end of next year. So that's quite aggressive, as you can see, relative to sort of the moves that we've seen historically in terms of tightening and getting rates, back up to the sort of levels we saw, a decade or so ago. What's also interesting is that if you look at what's priced in versus what the pricing in for the US Federal Reserve, they're actually pricing in as much, if not a little bit more, in Australia versus the US. So the US, has inflation at 40-year highs. I'll go into some of the issues at the moment, but not only is it's aggressive in Australia, but it's basically saying that we're going to raise rates as much, if not a little bit more, than what the Fed will do over the coming year, which, at the end of the day, yes, the RBA is going to be raising rates, but as I go into, it seems unlikely that they'll need to go as far as the market does expect. But the backdrop is that inflation has picked up in Australia. A lot of it is supply chain bottleneck issues, but the big issue, why the RBA is raising rates, is not necessarily because inflation is rising and it's a problem. We think it's going to get out of hand. It's more that the emergency that we had during COVID has passed. The economy is rebounding from COVID. Unemployment is low; it's down at 4%, and the case to keep rates at 0.01% is no longer the case. And they were basically saying they'll keep them that low until inflation seems to be sustainably back in the band, and they're waiting for evidence of wage inflation to pick up. But given the lift in inflation that we've seen, the stronger than expected lift on the back of largely global pressures at the moment, they haven't waited for wages and they've decided to go a bit quicker. So that's the backdrop as to what they're doing. But importantly, as I'll discuss, they don't need to slow the economy in any great way. This is about renormalizing rates, getting them back up to a more normal level, without necessarily wanting to slow the economy too much, which is a bit different from what the US has got situation. So if we just go to the next slide there, and these are one of the reasons that rates may not go up as much as the market anticipates. As the first slide there is house prices relative to income, and you can see that there's been a trend rise in house prices. So so that means that mortgage affordability for a given level of interest rates is a lot tougher. You've got to pay a lot more on a mortgage. Household debt's also been creeping up. So if we just go to the next slide, the other issue, and I'll refer back to that in a minute, but the other issue is that if you look at the bottom right corner there, wages growth as officially measured by the so-called wage cost index at the moment is still only 2.3%. That's the annual rate of wages growth, whereas in the US, as it's measured, it's running at 4.5%. So unemployment is low, as similar to what it is in the US. It's a bit higher than in the US, but nonetheless, broadly around that 4% level. But we haven't had the wages break out to the extent that the US has at the moment. And one of the reasons I think for that is that the JobKeeper program allowed workers to, get re-employed pretty quickly, with their previous jobs as we recovered from COVID. Whereas in the US, there was no JobKeeper program, and workers have basically taken their time to decide where to go and work, once they've lost their jobs and the economy's reopened. So rematching workers with jobs has been a bit harder in the US, and as a result, employers have had to jack up wages to re-entice workers back into the to their jobs versus other jobs, as everyone was suddenly scrambling for workers. That's going to be important also when we talk about the US later, as to whether or not the increase in wages we've seen in the US is a one-off effect. Is it just a one-off lift over the past year to get workers back into the workforce, having been unemployed or scared of getting COVID, various reasons for why people stayed out of the workforce over the past year. But will that inflation process continue, or will it start to die down? It's going to be a big question. And in fact, a pretty critical question for financial markets as we go forward. The other point there is core inflation, as you can see at the bottom right, it's above the RBA's target band, 2 to 3%, but certainly less than what we're seeing in the US. So core inflation on some measures in the US is running at 5 to 6%. Whereas in Australia, it's still just around that 3% case. So the argument that we need to be as aggressive as the Fed, at this stage at least, seems quite weak. So it is curious that the markets are pricing in, very aggressive rate rises in Australia, matching that of the Fed. Just moving right along, and just on that point about how interest rates. So this is focus on the bottom right, the bottom right-hand slide there, and that's my estimate of a mortgage repayment ratio. And basically, what it is it's a calculation of the percent of income that two people working full time, a male and a female, with their after-tax income. So you calculate, the average earnings, full-time earnings for a full-time male and a female. So just as a representative sort of household, and what percent of income needs to be devoted to pay off a mortgage to buy a medium-priced home, assuming a 10% deposit. And there's a lot of different housing affordability measures out there, but they broadly tell you the same story, that if you look at it over time, that mortgage affordability ratio has actually been pretty flat, around about a 30-odd% level. So all of the increase in house price, basically, and so what's happened over the past few decades is that we've had a trend decline in interest rates. Sorry, stay with it first slide there. Trend decline in interest rates. If you go back one slide there, trend decline in interest rates, and what we've responded to that by jacking up house prices relative to income, such that the percent we pay and our mortgages has remained broadly stable over time, albeit with cycles. Now, having as that a backdrop, if you look at it today, we're a little bit above average in terms of repayment ratios already, even with the cash rate low. And that's because we've had a nice house price boom since COVID. And what I've done there is plugged in what would happen to that repayment ratio if the cash rate went up by 2%, and if it went up by 3%, whereas the market's close to 3.5%. And as you can see, it would imply a very steep increase in mortgage repayment ratios. So affordability of homes would really drop in a significant way, and you would figure that would have a negative impact on house prices, potentially on consumer spending. And so as a result, that's another reason to think the RBA won't be as aggressive, or won't need to be as aggressive in raising rates, because maybe a 1 to even a 2% increase in rates could have an effect in maybe taking the edge off the economy, and we may see enough signs of a slowdown that the RBA may decide, we don't need to raise rates a lot further. So barring a major breakout in wage inflation, which at this stage doesn't seem like it's happening, there's no reason for the RBA to engineer a big slowdown in the economy, and hence to require a big increase in interest rates. On the next slide, if you look at the top right slide, that is the nominal house price in Australia, so the average house price, and I've got the declines in house prices relative to their peak levels. And this is using the ABS quarterly measure, and just in the last couple of months, just an update from CoreLogic, they broadly show similar trends. But point one is that if you look at nationally, we have had nominal house price declines in the past. So, there's a lot of headlines now about house prices declining. And if you look at it, you know, even as recently as a few years ago, we had a up to 10% decline in house prices nationally, driven largely by Sydney at that moment, due to macro tightening in credit conditions, which saw the once booming Sydney market correct. But even before that, you know, during the GFC and periods of rising rates, you know, we've had a house price decline. So nominal house price decline as mortgage rates go up is not out of the ordinary. Now, we're probably looking at, you know, I think consensus is something like a 10%, possibly 15% decline in house prices nationally. So we're looking at a potentially bigger decline than we've ever seen, or we've seen in the past few decades, just given the magnitude of interest rate. You know, if the RBA raises rates by 2%, for example, their own estimates suggest house prices could fall by about 15%. So that would be certainly bigger than we've seen. But again, a lot of the, you know, it doesn't necessarily mean that, you know, people are going to be defaulting on their loans and there's going to be, you know, an implosion in the economy. It's more like a, you know, a resetting of prices, and really taking prices almost back to where they were a year or so beforehand, because we've obviously had a big house price boom just in the past year. The other slide I've got there is just some relativities, just to show you that the change in prices relative to, so that's the ratio of prices in different capital cities relative to the median, and just it's a handy way of looking at, you know, cycles within cities. And as you can see, there's no such thing as a national housing market. Generally speaking, cities can move to, you know, they have quite different cycles all across the country. Because of the decline in interest rates due to COVID, we did enjoy house price boom. So it is true that prices have increased everywhere more recently, but beyond that, you can see different cycles happening. So if you look at, you know, Melbourne relative to Sydney, Melbourne's had a trend increase in prices generally over time, prices getting closer and closer to the Sydney level. What else is interesting? So if you look at Brisbane, Adelaide and Perth down at the bottom there, relative to the sort of median, they've been trending down of late and are looking, you know, relatively cheap compared to, say, Sydney at the moment. And if you look at Darwin, you know, quite a noted cycle there as well. So lots of different trends going on at the moment within the capital cities. But broadly speaking, it's probably likely that house prices may weaken in many cities over the coming year or so, because what's going to be driving that is interest rate trends. It's all right. Now, just going to the next slide. Yeah, so just in terms of the Fed outlook, so if we just look at the Federal Reserve outlook, just go to the next slide there. Thank you. Here we go. So this is if you recall that slide I showed you about wages. So in the US, wage inflation is a lot stronger, running at 5 to 6% on many measures with that unemployment low. So this is really the big problem in the US. So inflation has clearly picked up. A lot of that, though, is you can attribute to, you know, supply, you know, it's well-worn phrase now, supply chain bottlenecks, but demand running ahead of supply, problems in getting imported goods into the country to deal with a very strong level of demand, particularly given lockdowns in Asia at the moment, particularly China. But that aside, I mean, the other problem is that, you know, the labour market is throwing off big wage increases, which could filter through and sustain high inflation. So that's why the Fed is aggressively looking to raise interest rates. It actually does want to slow the US economy down. It doesn't want to cause a recession at this point, but it does need to slow the economy in a way that, given wages are still relatively benign in Australia, we don't need to. So that's the big difference between the US and Australia. So we just go to the next slide. And so as a result, our markets are aggressively looking at the Fed raising rates up to 3% by the end of next year. And to my mind, you know, that's actually a fair expectation given the strength of the economy. So I wouldn't quibble with that. all I would quibble with is whether the RBA needs to follow the Fed to the same degree for the reasons I outlined earlier. Let's go to the next slide there. Now, just about the Fed. So what the Fed is trying to do now is engineer us. Basically, the Federal Reserve, the US Central Bank, thinks it can raise interest rates, slow the economy, get inflation under control, and not cause a recession. So if you look at the Fed's forecast, they're not forecasting a recession. I mean, I guess they rarely would, but their forecast suggests the unemployment rate can stay low, but inflation nonetheless can drop back down toward a 2 to 3% level by the end of this year. Now, if you look at, there's been 11 tightening cycles, or I've identified 11 cycles. So that is the US federal funds rate there. And so it has been possible for the Fed to significantly raise rates, you know, on several occasions and not cause a recession. So you look in the mid 60s, the mid 80s, the mid 90s, and most recently in 2018. In other times, it's raised rates and a recession has followed. But what I would argue is the Fed actually, to my mind, the question is not can the Fed avoid a recession. Because I think if the Fed wants to avoid a recession, it can avoid a recession, because if the economy does start to slow, it can throw, and it doesn't want that to happen, it can throw policy into reverse. It can stop raising rates, it can start cutting rates, as it did in 2019. So I don't think the concern at the moment is, will the Fed make a policy mistake and cause a recession? The question is, does the US need a recession to get, will it take a recession to get inflation under control? And that's the issue, because if it does, then the Fed may be under pressure, you know, to slow the economy to get wages growth down. And then the other scenario is if it does require a recession, will the Fed, you know, basically do that, or will it tolerate inflation staying high for longer? So there's actually three scenarios out there at the moment. There's the optimistic case and the base case of the Fed, and probably where I'm still clinging to at the moment is that we can get a slowdown in the economy, supply chain bottlenecks ease, some of the wages pressures in the US that we've seen will start to ease because it was a one-off movement to get workers back into the workforce, which they have now, you know, got back into the workforce. So inflation can ease without causing a recession, in which case, you know, markets could bottom, you know, within the next couple of months. The US market's already down 20%, and you know, things can look a lot better thereafter. The other scenario is the Fed needs a hard landing and get inflation under control, in which case the markets could go a lot further down. Or the other scenario is the Fed needs a hard landing but avoids doing that and inflation stays higher for longer. Then that's not going to be good news for bonds. It could be okay for equities, and it'd be particularly good for commodity type exposures such as Australia. So there are the three sort of scenarios out there at the moment. But that's the US story at the moment with the Fed funds rate. If you just go to the next slide there, and you can see the big, and those dotted lines where the Fed, the dark orange lines are those times where the Fed basically avoided a recession. And you can see the big distinguishing characteristic between hard and soft landings is whether or not the unemployment rate goes up. So in those soft landing scenarios, you can see there was no material increase in the unemployment rate. And that's, again, what the Fed is currently trying to forecast. Go to the next slide there. And getting that unemployment rate, and this is the rise in the unemployment rate from its 12-month low. So it's the increase in the unemployment rate relative to the low we've had in the previous 12 months. So it shows the increase in the unemployment rate in the US over time. And you can see that basically in expansions, the unemployment rate rarely lifts by more than 0.5%. But if it's increased by 0.5% from its 12-month low, generally speaking, the economy has already tipped into recession. So 0.5% seems to be the tipping point. So that's going to be a very good indicator of the trend in the economy and whether or not it is tipping into recession. Now, one of the concerns is that once the unemployment rate's increased by 0.5%, it really stops there. So if the Fed ultimately decide it needs to increase the unemployment rate a little, historically speaking, nudging it up 0.5% has usually, you know, the unemployment rate's typically gone up a lot higher than that. So, you know, engineering a soft landing and trying to get a bit of an increase in the unemployment rate, if that's what they end up deciding, can be quite hard, because once it starts rising, you know, negative negative effects multiply in the economy, and you can reach a tipping point, and the economy could tip into a recession. So engineering a soft landing with a small increase in the unemployment rate has been hard and actually never been achieved. But that's one point. The second point is something I'm looking at carefully is that trend in the unemployment rate. And at the moment, it's still trending down. It's still very low. So the risks there, at this stage, still very low. But ultimately, the question is up to the Fed. Do they decide that they need to slow the economy down to get inflation under control? And if they do, then what's happening now almost doesn't matter because it's really up to the Fed. Go to the next slide. And soft landings have also happened with inflation usually pretty low. So again, if you look at those orange lines, the orange dots where you've had soft landings, you can see that inflation has, well, apart from say the mid 60s, I mean, arguably you could say that the mid 60s where they didn't create a recession was almost a policy mistake because inflation did continue to rise through the 60s. But in the 80s, in the 90s, and most recently in 2018, you can see that there was no material lift in inflation that they were dealing with at the time, so they could afford to only go for a soft landing because there was no sign of inflation picking up. Challenge at the moment, of course, is if you look at that core inflation number, it is clearly accelerating. So the task is even harder, compared to previous episodes where they did engineer a soft landing. Just in terms of financial markets, I want to make sure I leave enough time for all of this. So the top two charts there are basically the performance of bond indices, so like the bond market performance vis-a-vis a cash index. And we can see it's closely aligned with interest rates. So the yield on it's a global bond aggregate measure of the yield on the global bond index there, and it's inverted. So you can see that we've had that the yield on the global bond index, if you like, has gone from a low of 1%, or actually, in fact, under 1% back in late 2020 through 2021, and it's increased to 2.5%. So a very significant increase in interest rates as recently since late last year, and that's because central banks, particularly the US, has looked to aggressively raise interest rates, and hence, as you can see, when yields rise, bonds tend to underperform, and hence that's why if you've got a portfolio that has bonds in it, that's why you've had a negative return from bonds most recently, because that very aggressive increase in rates. It's also true in Australia. If you look at the top right slide there, that bond yields have lifted, and bond performance certainly relative to cash has underperformed. And so, a rule of thumb, basically, where bond yields go is where the overall return from bonds tend to go. So when bond yields do start to level out, that's when the pain in terms of bonds will end. But that's been the story so far. I think we're close to the end in terms of the bond market sell-off. I mean, as I said, there's a lot of aggressive interest rate increases already priced in. If inflation does start to moderate in the US, in fact, overnight, we got an updated CPI number. The market sold off on the number because it was still a bit higher than expected, but at least the annual rate, the year-on-year rate, did tick down. So the headlines US inflation went from 8.5 to about 8.3. Market was expecting 8.1, so it didn't fall as much as hoped, but nonetheless, tentative sign that it is starting to ease. But so there's been weakness in bonds. You can see credit spreads have blown out as well, and that's hurt corporate bonds relative to government bonds as well. So it's been a pretty brutal period for investors in the bond market, given the speed of the shift in interest rates. And also, just a final point there, you look at, there's been a trend, Australian bonds have also tended to underperform global bonds because of that. The market's been pricing in aggressive rate rises here as well. Let's move along. Now, as I said, my modelling suggests that that bond yields may well be close to a peak here, and basically the way I model bond yields is based on where the cash rate will be in a year's time and what the market expects that cash rate to do over the following year. And my modelling suggests that the market won't price in a lot more tightening than what we've already got, and basically the Fed and to a lesser degree the RBA will basically will do what the markets expect, and by later next year we'll have a cash rate. In the case of Australia, maybe a cash rate back up to say 2.5%. In the case of the US, 2.75%. But the market's then not expecting any further tightening thereafter by 2023. So if at the end of 23 the Federal Reserve cash rate is at 2.75 and the market doesn't expect any further tightening, and Australia is at 2.5 and they expect no further tightening, then bond yields, 10-year bond yields in Australia and the US can ease back to, well, in the case of Australia, ease back under 3%. And the US also, they're around about 3% now, but basically not go a lot higher. So that's just some modelling to say, where things might go, even with central banks raising rates. Now that's critically dependent on the central banks not raising rates beyond 3%. The markets at the moment, they are expecting a move higher than 3%. Again, I can't see the case, at least certainly in Australia, for that. And I actually think in the US, as they start raising rates, we are going to start to see a slowdown in that economy. The housing sector is certainly going to start to slow down because mortgage rates have already gone up in a big way. Let's go to the next slide. Aussie dollar. Look, Aussie dollar has been a lot of mixed forces there. My model has the Aussie dollar should be around about the low 70-cent range. It's basically there at the moment. I think the Aussie is going to meander in this low 70-cent range. It's been pulled back at the moment. There's been conflicting forces. On the one hand, iron ore prices, as you can see there, have rebounded since late last year. The Chinese lockdowns have hurt iron ore prices more recently, but still, they're still relatively high at over $100 a ton. But the big driver of the decline in the Aussie dollar in recent weeks has been the sheer strength of the US dollar. And I think with the Fed being more aggressive than the RBA over the coming year, the US dollar should remain firm and the Aussie dollar should remain soft. So the two things are US dollar remaining firm, and also as we get this slowdown in growth, iron ore prices, I still believe, should start to ease back down again. So I'm not super bullish on the Aussie. If anything, it's going to stay in the low 70-cent range and maybe break under 70 cents. I've long held that view because I think iron ore prices are too high, and I don't think the RBA will raise rates as aggressively as the Fed. Just to the next slide there, global equities. I mean, what we've seen, global equities are having a pullback, even though as you look at forward earnings in the top right slide there, they've kept rising. So all through the pullback in equity markets since the start of the year, earnings of the market has been growing because the global economy is still growing. So all of the pullback in the market has been due to the PE ratio coming down. It's gone from, at its peak for global markets, for a peak of 20 at the start of last year, now down to under 16 times earnings. So nice pullback back to the levels we saw prior to COVID. And what's interesting is that if you look at the bottom right slide, the rise in interest rates have pulled down that PE ratio such that the equity risk premium, or the yield, so the PE ratio inverted gives you an earnings yield of the market. You take away the bond yield, you get what's called the equity to bond yield gap in this case. And so if interest rates rise, I mean, one way the market could deal with that is that the equity to bond yield gap narrows so that the P ratio doesn't fall, but the difference between the earnings yield of the market and the bond yield narrows. But what's been interesting is that gap has it's fallen a little bit, but not by a lot. So a lot of the adjustment in markets to the rise in interest rates has come from that PE ratio coming down. So that's good news in a way, and that valuations are being restored. Now, to some extent, if we do get a soft landing and earnings growth hold up, then that bodes well for the market because as I said, PE ratios are now back to more reasonable levels. But the issue going forward now will be, will earnings hold up? Will the Fed need to engineer a hard landing or not for the economy? Because if they do, then that positive earnings outlook will start to deteriorate, and we could get more weakness in the market. Going forward. Next slide. Australian, look, same story, very similar here. So you've had the PE ratio come off quite a notable way in Australia now. So it's trading at 14, 15 times earnings, about 15 times earnings. So back now to the levels we were prior to COVID, and driven down by the lift in interest rates. Now the earning, I've not been relatively bullish on the Australian market vis-a-vis global markets simply because the earnings outlook has been softer. But it's fair to say there's been a big upgrade to the earnings numbers. If you look at the top right slide there, the earnings estimates for this year and next year have been upgraded in a big way. Because the economy has recovered from COVID. We've had an upgrade to the commodity price outlook. And so that's really supported the earnings numbers. So that's good. Earnings have lifted. And at a time when the market has sort of gone in a sideways range, that's added to the downward pressure on PE ratio. So earnings going up, all else constant, pulls down that PE ratio. But again, the challenge is that the earnings growth outlook from here is still quite muted because analysts are expecting commodity prices to fall back down again, which will take the shine off resource sector earnings in particular. So it does depend on how far commodity prices fall back down again. If they stay high, again, one of the scenarios I mentioned is where the Fed avoids a hard landing, even if inflation stays high, in which case commodity prices could remain quite strong, and inflation remain firm, and that would favour the Australian market. But that's a situation with the equity market at the moment that the value, certainly the PE ratio, has come back down to a much more attractive level than what we've seen over the past couple of years. Just in terms of investment themes, firstly, look, and this is a chart of the orange line is equities versus bonds. It's the relative performance of growth assets versus defensive assets. The grey areas are US recessions. So again, there's a group in the US that date recessions to the month, and so we've got a nice historical record of when recessions have begun and ended. And the unemployment rate in black is the US unemployment rate. So it gives you a broad idea of cycles over time. And as you can see, basically, when you're in an expansion phase, equities tend to beat bonds, as you would expect. Earnings growth is strong. Interest rates are rising, so that tends to relatively hurt bonds. And the periods where equities do the worst is during recessions. But we can get corrections in equity markets, and the bottom line there is the drawdown curve, so the decline in equities versus bonds. And you can see that even outside of recessions, you can have pullbacks of the market of the order of 10 to 20%. In 1987, the pullback was a bit bigger than 20%, but it was only very brief. But other than that, usually the pullbacks are no more than 20%. 2018 was an example where it was on a month-end basis, it wasn't quite 20%. But basically, the worst damage in terms of equity performance happens during US recessions. At the moment, I'm not expecting a US recession. So I think this should be a correction. Though having said that, the S&P has already declined by about 17% from its lows. So it's a pretty significant correction to date. But if we do tumble into recession, the decline in equity markets could be a lot worse. If you look at the declines during the last during COVID, it was on a daily basis, it was down 35%. But if you look at 2001 and the GFC, the overall decline in markets was something like of the order of 50% in the US market. So, from an asset allocation point of view here, it's time to be certainly not overweight equities. I think, being, cautious, being neutrally exposed here, seeing this as a correction, but I'd be wary of jumping into the market at this point and thinking the worst is over, because there is a risk that, although my base case is the Fed can avoid a hard landing, I wouldn't be counting on that at the moment. So I wouldn't be, necessarily jumping into the market, because if things do go into that direction, the equity market declines can be a lot bigger than what we've already seen to date. And just on that, I mean, this is a chart of the declines in the US market during bull markets. During recessions. Every recession is in the mid 50s. And the point to say, on average, the market has declined by about 30%, 10% of which has happened in the lead up to the recession. So the point of this chart is to show you that even though there is some damage to equity markets in the lead up to recessions, if you can sort of anticipate that the economy could be turning down, there is still some value in trying to be defensive, because there's a lot more damage that basically 2/3 of the damage happens in the months from which the recession begins. So in the first month and thereafter, on average, 2/3 of the decline in the market has happened in that period. So there is some value in trying to look at the economy carefully and trying to anticipate whether or not it will tip into recession, because if you anticipate that we're not quite there yet, but we're close, and maybe we are already tipping into recession. I'm not saying that's happening now, but when that time comes, and the markets are already down, it's not necessarily too late to get out of the market, because historically speaking, markets have declined more in the recession that then kicks in. In terms of global equity themes, look, to be honest, this is not a time to be playing thematics in a big way. Like, because I mean, at the moment we're in a global equity correction. Markets could go lower. It's hard to see a catalyst for a massive rebound. And if markets do go lower, basically all equity market areas will tend to weaken. So when I talk about thematics here, we're talking about, things that might outperform and maybe, in that sense, go down less than what other areas will do. When you're in a bull market and things are rising, thematics, make more sense from an outright point of view, because you're talking about things that were going to go up more than others. But when you're in a corrective stance, really, to say, for example, growth value companies are going to outperform growth companies, you're really kind of saying that, well, maybe they're going to fall by a bit less. So I wouldn't be too, I think that, being cautious, being defensive at the moment is probably more appropriate and more important than trying to decide what thematic to be riding. So I just put that out there. But having said that, what we are seeing within that field is that the growth to value rotation continues. So rising interest rates continue to hurt the technology sector, which has been a massive outperformer in the years up to COVID and in the first couple of years since COVID. But since late last year, there's been a massive change out of technology, particularly high PE ratio technology companies with great growth potential, but trading at high PEs have certainly weakened with interest rates going up. Things like energy, commodities, Australian resources, they are all doing well in this environment. And you can see that the Australian market, vis-a-vis the rest of the world, has had an uptick in its performance as part of that growth to value rotation. Elsewhere, not a lot. US has started to underperform the non-US parts of the global market, but you know what? Europe is under pressure as well, of course, with Ukraine. So it's really the key thematic at the moment is being in, to the extent you want to play it and you think inflation's going to stay high and resources are going to stay high, maybe the Fed avoids a hard landing, even if it means inflation stays high, then the resources areas of the market, the energy area of the markets are the ones that are going to do the best. Let's go to the next slide there. And I've just got some examples of that. Again, I put out a blog about this a few weeks ago. So you can see that our fuel ETF, FUEL, our QRE, which is our Australian miners. So fuel is global energy producers. QRE is Australian resource companies. MNRS is global mining companies. And food is global food producers. So these are all ETFs and all ways of getting exposure to companies in the the commodity space. And across, I've got the relevant commodity prices: oil, iron ore, food prices, and gold. And look, and the orange line is their relative performance to global markets. So as you can see, they have been outperforming this year with the lift with the lift in commodity prices. So that, and I think that theme is going to continue until such time as the markets basically conclude, or we do fear that the US will go on a hard landing. So at the moment, it's an inflation story. It's a case of the US economy being too strong, and so commodities are running hard. But when and if we reach a tipping point, so and I just put this as a caveat, if we reach a tipping point where we start to talk about growth slowdown, then I think commodity markets may also come under pressure. So just be wary of that. Just go to the next slide there. Yeah, global equity, if you look at different regions of the world, Japan's doing well. So Japan's an interesting case because other central banks are talking about raising interest rates. Japan is still steadfast in wanting to keep rates, very, very low because, they still think their economy needs it. They're still not convinced that inflation that's picking up is high enough. So Japan, funnily enough, is still maintaining a very accommodative policy stance, and as a result, the yen has weakened in a major way, and which in turn tends to help the Japanese equity market because it helps their exports. So a cheaper yen is good for Japanese exporters, which in turn is good for the Japanese market. So you can see Japan starting to outperform at a time when Europe is still under pressure. So that's probably the standout developed market exposure at the moment, given the problems in the US, given the problems in Europe, and given the stance of the Bank of Japan in not wanting to raise rates and tolerating a much weaker Japanese currency. Emerging markets still pretty mixed, so not a lot. India I've got there as a relative performer. Look, it's fairly mixed performance, so there's no sort of standout trades. I just mentioned the UK. Look, there's some tentative signs there of the UK outperforming. UK is very cheap relative to global markets. UK also has a lot of energy companies, has a lot of consumer staple companies, so it actually has quite a relative value exposure, if you like. So in a relative sense, I think UK, along with Japan, one of those areas of the global market that can outperform at the moment and sort of do relatively well for different reasons, but nonetheless, do better than the US market, do better than global markets overall. And just in terms of you've got the global banks should be doing better than they are at the moment. You can see, generally speaking, when bond yields are rising, global banks tend to do better because their margins widen. But their performance this year has been a little bit patchy, somewhat disappointing as a result, because I would have anticipated banks have a better run. I think one of the factors there is that concerns about the Russian sanctions and Russia defaulting on various financial obligations, defaulting on its sovereign debt potentially eventually, is keeping banks in check, and European banks in particular under a bit of pressure given their Russian exposure. So I think the bond yield story, which should favour banks, is being offset at the moment by the sanctions that are being imposed on Russia. The Nasdaq, as you can see, it remains under pressure with rising bond yields. When we get close to a peak in bond yields, and we could be there soon, I think the technology underperformance will start to level out. But thereafter, again, in an outright sense, what you've got to fear is, whether the US goes into a hard landing, because technology may stop underperforming, but it may still weaken if we start to fear a global growth slowdown. Defensive sectors, drugs, that's global healthcare, that's doing okay. That's a relatively defensive sector. Now, quality, we do have a global quality ETF, which, given the nature of the screens at the moment, does tend to have a big technology exposure, some of those big US technology companies. So it's been caught up in the, although it has outperformed consistently over time, at the moment it's suffering a pullback because it's been caught up in the technology pullback at the moment. The last one there is QUS, which is an equally weighted US ETF, has outperformed, showing signs of outperformance, again, because it has less exposure to the big tech names in the US, given it's an equal weight. All the companies in the market equally weighted, whereas the S&P 500 is very top heavy because it's a market cap weighted index. It's very top heavy in the big technology companies at the moment. So that's what's happening in that regard. So that's just a summary of the situation there. Some of the resource exposures there. So, you know, the things we've loved for a long time: global quality, global technology. Look, remaining under pressure at the moment, given the trends in bond yields. And again, I'd just be a bit wary about wading into the market at the moment, because we are still just waiting to see about, you know, whether how much the US economy needs to slow. Things like resources are doing well in Australia, QRE. Our crypto ETF, again, what's been interesting, Bitcoin has had a major pullback. You know, cryptocurrencies are showing a somewhat stronger correlation that many advocates hoped, stronger correlation with equity markets of late, partly because a lot more retail investors are starting to invest in crypto, and so the sort of fear and greed and the sort of, you know, psychological passions that drive markets generally are starting to infect the crypto market as well. So our crypto ETF has had a bit of a pullback, but, you know, if you like crypto currencies and you think things are getting too beaten up, then that's a great way to play that exposure when things do start to turn around for markets and the technology sector in particular, things like the NASDAQ. There are our inflation exposures I mentioned. QAU is gold bullion, food producers, Australian energy resources, and global energy producers. So at the moment, these are the things that are doing well, and should continue to do relatively well over the next few months. And I mentioned that our value exposures. I probably don't need to go into that any great detail because I've already talked about those. So we'll just go to the next slide. Look, and that's pretty much it. That's the wrap. Just some things to consider. Look, I wish I could tell you that the worst is over, or hunker down. There's a lot worse to come. We really are in an interesting inflection point for markets. And the ultimate, and again, I'll just repeat, the biggest issue in markets at the moment, it's not Russia, Ukraine, it's not Chinese lockdowns. I mean, these are all kind of relevant to an issue, to a degree. It's at whether the US economy needs a recession to get on top of inflation. And at the moment, we don't really know the answer. We're hoping that inflation is going to moderate without the US going into recession. And if that is the case, then the downturn in equity markets shouldn't be a lot further. But we're waiting to see those inflation numbers come off. The other hopeful sign I did mention is that we are seeing tentative signs that wage inflation in the US is starting to ease as well. So I wouldn't give up on that idea, but we don't have a definitive answer. So I would I think caution is still the relevant watchword at the moment as we watch very closely the US developments over the next few months. Thanks for that, and I'll take some questions.
Excellent. Thank you so much, Dave, for covering that. I'm sure it was very insightful for everyone.
Now is it working? Hear me okay now? Seems to be working. Okay, sorry about that. Gremlins in the technical system. So look, how do they get? Yeah, inflation has been proven a lot stronger. I mean, basically the global supply chain bottlenecks have fed through. No one anticipated Russia invading Ukraine, which has added an extra hit to oil prices and to food prices generally around the world. And so that's been the major catalyst. So Australia got it horribly wrong on the inflation numbers, and so did the many central banks around the world have got that wrong, and they didn't anticipate that the supply chain bottlenecks that we started to talk about early last year would last as long as they have. And also then adding impetus to that at the moment has been the Russian invasion of Ukraine. But so going forward, and not only that, there's just been a sea change in the RBA's thinking that they initially said that they would like the economy to run hot. They would like to see clearer evidence of wage inflation picking up before they raise interest rates. But the fact that inflation has already picked up in a big way has meant that they can't really afford to wait for wage inflation to pick up, because they now fear that the longer inflation stays higher with the RBA not doing anything, it could sort of create an inflation expectations type, lift inflation expectations and maybe embed that into wage and price setting behaviour going forward. So that's been a bit of a shift from the Reserve Bank. Well, a massive shift from the Reserve Bank. And I think generally speaking, the central banks experimented with a few things during this low inflation era that we had prior to COVID. So they experimented with something called forward guidance, where they basically promised not to raise rates for several years going forward, and they saw that as a way to keep longer term bond yields down. So they said, look, we've already cut rates to zero. How can we now lower longer term bond yields even more? And say, well, let's not only cut rates to zero, let's promise not to raise those rates for several years. And so that's what they did into COVID and through COVID, and then they've just been smashed by the increase in inflation due to these supply chain bottlenecks, and also people say supply chain bottlenecks. What we're also dealing with is just very strong demand. Why are there bottlenecks? Because demand is so strong in the main part. And in the US and to a certain extent Australia, we rebounded from COVID pretty well. Stimulus helped, but with hindsight, we probably had too much stimulus. And so the economy has rebounded far stronger than anyone expected. And that has added to some of the inflation that we're seeing. And so that's why now they want to make sure growth to some extent, particularly in the US, does slow back down again.
Excellent. Thank you very much, David. And I guess with that, what's the probability, and a question here is really around sort of stagflation event where we're seeing inflation run, but affecting growth?
Well, it's fair to say we're kind of in a stagflation. Well, are we? No, we're not quite in a stagflationary. Stagflation is when unemployment's rising, so growth is weak, and inflation is strong. Now, at the moment, inflation is clearly strong, but unemployment is not weak. Growth is not slowed. So at the moment, this is a demand-driven world. Why commodity prices are up, why unemployment in both Australia and the US is still trending down. So this is not a stagflationary environment. A stagflationary environment will happen if we get further massive supply disruptions which push up commodity prices, push up prices. Central banks have to respond by slowing the economy, by pushing up unemployment, so we do get weak growth, but also at the same time inflation remains high. So we're not in a stagflationary environment at the moment. It may feel as that because interest rates have lifted, but interest rates have lifted because of this, ultimately because of the strength of demand, particularly in the US. But in terms of investment implications, a stagflationary environment and the sort of environment we're in at the moment, where rates are rising significantly, which in turn has hurt equity markets, has meant that bonds and equity markets have weakened. So it looks like a stagflationary environment because the financial market implications of it are similar in the sense that both bond and equity markets have weakened at the moment.
Excellent. Thank you very much, David. There's a question here just around fixed income. Obviously, people are looking at their portfolios and seeing red on both sides of the asset allocation piece. Focusing on fixed income in itself, there's a question here around what are the sort of best ETFs in general that you would look for in the current environment of the short term, be it fixed or floating?
Well, there's different. Look, if you think we're close to the end of the bond yield sell-off, as I said, you know, Australian bond 10-year bond yields are now well over 3%. 3-year bonds are over 3%. So the market's pricing in a cash rate of 3%. So unless you think they're going to go a lot higher than 3% of RBA, you've got to think bond yields are close to a peak here. In which case, getting back into fixed rate bonds is a good value. It does offer value. So, for example, our long duration corporate bond ETF, CRED, CRED, which along with other bond exposures, has obviously had a negative impact of the lift in bond yields. So the price performance of that has been very weak so far this year. But the upside is that you look at it today, it's offering a prospective income yield of over 6%. And if equities do crater and we do get a slowdown in growth and central banks rethink, how far they're going to need to raise rates, then you may not only get that income, you may get some capital gain as also if yields then start to fall. So locking in nice bond yield returns at the moment, is starting to look value. Now, if you still worry about interest rates going higher, you are starting to get value even in so-called low duration or floating rate type bonds, because the cash rate going higher is going to give you a higher income. So a couple of things to look at there is Coupon, which is our floating rate bond ETF. So basically gives you the 3-month interest rate, which is closely tied to the RBA cash rate, plus a bit of a credit spread. So it's now offering yields of over 1% versus next to zero a year ago. And also hybrids. Yes, hybrids tend to weaken. I mean, if you're regular listeners to these webinars will know I've been a long advocate for hybrids as a defensive source of income. So they do offer attractive income and a lot more downside protection. They do weaken when equities weaken, but they tend to weaken by a lot less. And then thereafter they can bounce back. So they weaken because of the credit spread widens out. But relative to what happens to equities, it's a lot less. And the other advantage of hybrids, a bit like Coupon, because it's floating rate, as the RBA raises cash rate, the yield on hybrids will start to increase as well, because it's the yield they offer is the cash rate plus a spread. So and as that cash rate rises, that yield will go up. So fixed rate bonds, depending on you. Look, I think we're close to the peak of bond yields. So fixed rate bonds, I think, are actually starting to offer good value. But if you are still fearful of that and you want some defensive yield, Coupon, HBRD is our actively managed hybrid fund, and BHYB is our more passively managed hybrid fund. So there's different options out there for you.
Perfect. And there were a lot of questions that came through. So you've answered both of them in terms of what are your views there? But a lot of people who are already invested in bonds and in those duration or fixed rate exposures were asking, why would you stay in there? So I think we've answered a few questions on that. Now, I think we've got time for potentially one or two more. Just on the other side, in terms of equities, there's been a few questions around NASDAQ and I guess technology as a whole sector. And we saw that obviously hold up very well through COVID, and we had the stay-at-home stock story that saw indices like the NASDAQ perform relatively well compared to other markets. Why is it being so effective or more sensitive now than in what we saw through COVID, or because of these geopolitical and interest rate movements?
Yeah, look, it's an interesting. Well, basically, what's happening is the rise in interest rates have negatively affected many of the sort of high priced technology companies. So companies, but not only that, even the FANG stocks, even the Googles, the Amazons and Facebooks have been hard hit. So I think there's two things going on. Firstly, stocks with a lot of great potential, and we have a lot of thematic ETFs that are looking at things like the future of food, cybersecurity, robotics, a lot of these disruptive technologies, which the long-term growth outlook is fantastic. But they probably did reach a point where they were trading at very high PE ratios, helped by the fact that interest rates were so low. And now as interest rates have gone up, the PE ratios on those companies is correcting down. The longer term outlook for these companies hasn't changed. What's happening is that No one questions that robotics or climate change, cloud computing, cyber security. No one questions these things aren't going to be great big, growth outlooks in the future. All what markets are doing is saying, we don't want to buy companies at 40 times PE. We'd rather buy them at 30 or 25. So they're coming down as yields rise. The second thing that's happening is that what I call the COVID premium. So if you think about COVID in the first half of 2020, technology had a massive run up. It outperformed because people were shopping online, working from home, things like Peloton, Netflix, all these sort of companies, even Amazon to an extent, all had massive runs. And so we're getting an unwinding of that COVID premium as things return to normal. People go back to the offices, people go back to the shops. And so we're getting an unwind in a lot of those areas. So that are the two things that are driving it. And so, and I think, that COVID premium basically needs to wash out. And in terms of the first factor, it comes down to how far bond yields rise. If we think we're near the end of that process, then I think we're near the end of the relative underperformance of technology as well. And I stress relative underperformance, because again, I'm not saying, because if we do have a hard landing in the US, things can still weaken, but the relative performance of it may level out.
Fantastic. And look, we're a bit over time, but I will finish with one question, and it's obviously very topical at the moment, is obviously we'll be going to the polls very soon. What's your view? I guess there's a question here in terms of actually if Albanese gets in on a minority government or parliament, what were sort of the implications to markets on that, or your views?
Look, I think if they win in an outright sense, that'll be more market friendly than if they win in a minority and then require the independents to sort of, have form government, because I guess a lot of the independents, do tend to be a bit, I guess left leaning, you would say. So they may want some more interventionist policies, be it tax increases, maybe, stronger movement on climate change. But I think the only real difference between the two political parties, to be honest, is on the climate change front. They Labor Party, and even then, it's fairly marginal. I mean, they're both committed to net zero by 2050. Labor want to get emissions down a bit more quickly by 2030. So there'll be more incentives in terms of change there. But Labor's not proposing a carbon tax or anything like that. So I actually don't think there's going to be that much of and compared to, say, when Bill Shorten was running 3 years ago, they have a very small target strategy. So we got no issues with regard to capital gains taxes or negative gearing changes that we were dealing with last time around. So I don't think there's going to be that significant a change in a way that would roil financial markets. Only if it is a hung parliament, if it's undecided on election night, and then we're down to haggling with the independents, there may be a bit of negativity in the markets due to that uncertainty. But I think that will ultimately resolve itself. But the polling at the moment, you got to take the polls with a grain of salt. It looks like they're saying the Labor could actually win in their own right and not need the independents. But it's either going to be that, polls have been dead wrong in the past. So it may well be people waver at the 11th hour and decide, we're still going to back the horse that we know rather than back the one we're not too sure about. So we'll just have to wait and see how that plays out.
Fantastic. Well, thank you very much, David. And for everyone that's joined us today on the webinar, hopefully you've gained some insights. As mentioned earlier, the webinar and the recording and also the slides will be sent out, so you'll be able to go through anything that was covered today. And of course, next week we have our iPay webinar as well. So if you're interested in that, please register. But apart from that, I hope you have a lovely Thursday and look forward to speaking to you soon.
Bye for now.